Will now be recorded.
Today's session. Is my voice audible? One can just confirm. Yes, one of you can just confirm. Is my voice audible to you?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Okay, thank you. So please open up your Volvo case study, which you were doing in the last class. To the extent we have completed, please make sure you keep your files ready. In the meanwhile, I will share the screen with you. Yes. So we had done till the balance sheet computation, and we are yet to put up the cash flow statement and then free cash flow with equity, and then we have to arrive at the free cash flow equity answer calculation, and finally here's the IRR, internal rate of return. Okay, so I hope all of you have completed till balance sheet and have got this answer you worked out.
Yes, ma'am.
Okay, so we'll start with the cash flow statement. Right. So here we start with the cash flow statement. So for year 0, we have to, from year 0 to year 4, we have to update the PAT, which is profit after tax. Now for the year 0, it is nil. So for the initial year, we don't have any PATs. So here also we start from year 1, not with year 0. Okay. So your profit after tax or PAT is computed from year 1 to year 4 and not year 0. So year 0, it will be nil. So you can just give it as equals to 0. Okay. And then for year 1, just paste your PATs which you have got in your income statement. That is this. Okay, just paste these PATs over here. Equals to example this. Please paste the PATs for all the 4 years. So after you have posted off the PATs, next is depreciation. So again for year 0, it's nil. And for year 1, what you have computed depreciation above, same thing. one you can just take up, and for the rest you can consider. And you have to calculate your cash flow from the operations, the first stage. I've already discussed with you the cash flow statement. Okay, and how does it operate? What are the components of cash flow statement, where we have three segments: cash flow from the operating activities, cash flow from the investing activities, cash flow from the financing activities. So first we are calculating the cash flow from the operating activities. So you just want to sum up your cash flow from the operating activities. So equals to sum. So just take it up. Okay. So same thing, you can just put it up for the rest of the cases. Yes. Are you done? Have all of you got, are you able to get the computation for cash flow from the operations?
Yes, ma'am.
Okay. So now we move on to the capex. Capex is nothing but capital expenditure. Now, capital expenditure is in the year zero, we make the investment for the bus. That is nothing but 75 lakhs. And for every year, we do not make or go for the investment for the bus purchase. We do it off in the year zero, and not for every year we are going to purchase, right? So for year zero, we are only considering it as the purchase, and that purchase of the bus is your capital expenditure. So what you're supposed to do is, and very important, now here we are recording the investment made for the bus, right? So which means the funds are moving out. Nothing but it is a cash outflow. It's not a cash inflow when it comes to the capital expenditure. So what you're supposed to do equals to minus D6 equals to minus D6. So what is D6? Nothing but the cost of the bus. That's all. And then for the rest of the years, it will be just zero. We're not investing every year, as I've told you. That's it. So what is the net cash flow from the investing activities? Just the above part. Equals to this. That's all. So complete your cash flow from the investing activities. Next is debt repayment or issuance.
Mom, can you explain it again?
Investing activities.
Yes, ma'am.
See, investing is now year zero is the initial period of working out this complete purchase of the bus. So year zero, we are making all the investments. From year one, we begin all the operations, right? So in the year zero, we are investing for the bus, which is we are spending 75 lakhs to purchase the bus. So that is nothing but capital expenditure for the company. That capital expenditure is incurred in year zero itself. Every year, we are not going to make a bus purchase, okay, to consider the value. Okay, so only once we have recorded as capital expenditure and that is done, because it's nothing but cash flow derived from the investing activities. So how many times we are investing in the bus? We're investing only once. Capital expenditure. Rest all are the other expenses. So this capital expenditure as a part of your investing activities is recorded only in the year zero and not every year. So what we do is for year zero we take as 75 lakhs. Why it is minus 75 lakhs? Because it is an outflow of funds. It is not inflow of funds. So we take is that we take it as equals to minus d6. Okay, and for the rest of the years it will be zero itself. We're not investing the same amount every year, and net cash from the investing activities equals to capital expenditure for year zero, and for the rest as usual it will be nil itself. Okay.
Excuse me,
Yes, ma'am.
ma'am. Why is depreciation considered as a plus for the cash flows, ma'am, instead of a minus?
Depreciation.
Why is depreciation considered a plus instead of minus, ma'am, for the cash flows?
No, it is not considered as a plus here. Actually, it it goes on, and then finally we have the reductions in the later stage, right? See, to the profit after tax, we add up all your ancillary activities concerned to the operation. So it's not like we minus depreciation then we add back depreciation. So this is a cash flow statement where we take the summary of the inflows and the outflows. So it is not a direct addition to your profit after tax, because depreciation is an expenditure, it is not an income. So here to arrive at the net cash, okay, we calculate in such a manner. It is not a direct like we have to add back to the PAT. So it is a summary we are deriving to arrive at the net cash here. So afterwards, once we arrive at the net cash or the closing cash balance, you will automatically see the changes in the entire cash flow statement. So it is not a direct addition to your PAT.
Thank you.
And if you're done with your cash flow from the operations and cash flow from the investing activities, okay, so then we move on to the debt repayment or issuance of debt. So for the initial year, that is for the year 0, okay, so how you're going to consider? Equals to, so how you're going to compute this? This is your debt, okay. The opening values, you can just, with this table is what we had referred, right, to calculate your debt from year 0 to year 4. Same values we had posted here, if you remember in your last class, right? The same thing we are going to consider here. So how it has to happen is, see, minus, it will be 0 for the year, so it will stand by the same amount. And for the year 1 equals to, okay, that is minus the previous years. Again, so every year there is a repayment going on. Again, the current years, which is this of year 2 minus year 1's. Hold on. Equals to year 2's. Year 2 we have a debt and minus which is this. Yes. Again equals to, for year 3, the current value of debt minus your previous year, that is this. Equals to year 4 minus so like this you're supposed to calculate the debt repayment.
And can you explain this debt repayment one more time?
Debt repayment is, now for the initial year, for the year 0, we consider your gross value of your debt. So what is your gross value of your debt? It is here, right? The net amount. For year 0, it is 56,25,000. Okay, so which comprises of how much? 75% of your loan amount. So for year 0, we consider equals to, for the same year, year 0, which is here, minus 0. Why minus 0 is, we just take any previous balance as a computation. Now we don't have for year 0, it is nil. So just to follow the same pattern of repayment of your debt, we follow the schedule, that's all. But for year 0, your debt value stands at 56,25,000. So what we do is, we start from year 0 and end by year 4, and you know that by the end of year 4 the debt has to be repaid, it has to be nil. So what we do is, from year 0, how do we compute this debt repayment? Is, now year 0, the loan is sanctioned as 56,25,000. So equals to 56,25,000 minus 0, the previous year balance. We don't have anything. So from year 0, for year 0 it is a full-fledged amount of loan. From year 1 onwards, what happens? We consider the current year. So current year, how much we have debt for year 1? It is 44,98,507 minus your initial amount of loan, which is 56,25,000. So the difference amount lands up to this. Again, for year 2, we take the current year debt which is available 32 lakh 3041 minus your previous year debt. So we keep on working on the same and we get these values. So I'll just compute for you again. You can just trace it out. See, equals to, now what is the year one debt balance? It is 44,98,507. So I select that minus your previous year debt. Again, your year two current value of debt minus year one debt. Sorry, year one debt, that is this one. Then again for year three, current value is this for year three minus of year two's. That is this. And again for the year four. So by year four it has already been repaid minus year three's. That's all. So like this, we have to follow the pattern to record the debt repayment.
Okay, ma'am. Thank you.
Okay. So complete this debt repayment. I hope you have done with the debt repayment pattern. Next, we have the equity addition. Now, what is your equity addition? So, you know, equity, it was your 25% of the value. So the same thing you can just put up here, okay, as your equity addition. And again, it is not repetitively put up for all the years. How you have put up your capital expenditure for the initial year, the same way is your equity addition. Now debt you have to repay it every year, but the same thing does not work with equity. So equals to equity addition, that is year only. So same reference you can take, equals to D52. That's all. So once you put up your equity addition and then calculate the gross cash flow from financing activities, sum, that's all. And for the rest you can just drag it. So complete the calculation of cash flow from financing activities. So once you're done with cash flow from the financing activities, you can calculate the net change in the cash. That is the summary of, or I can say the sum of cash flow from operating activities, investing activities, and financing activities. So equals, so you can just add up like that only. Cash flow from the operations, cash flow from the investing, from the financing. That's all. So it will be nil for the first one, and for the rest you can just compute it. So you can get these values. So I've just elaborated this for you. So once you're done with net change in cash, you have to arrive at the beginning of the period, BOP. So beginning of the period for year 0 it is nil. So it is equals to 0. And for year 1, the same procedure. What is at the end of the year, and for this also the same procedures we have. So how do you compute it? Now for year 0 it is 0. Now for year 1, what happens? It is a sum of this. Okay. Again here also it is nil, here also it is nil, so it will be 0. Again here for you it will be equals to, so same thing is being put up with this for year 2, for year 3, and for year 4. And finally the end of the period equals to sum again. So complete the calculation of net change in cash, and then cash at the beginning of the period and cash at the end of the period. I hope you've got the answer. You're able to make the computations for cash at the beginning of the period and cash at the end of the period. Yes?
Yes, ma'am.
Okay. So now we had a missing figure in the income statement. Remember, we had to calculate the revenue there. So go back to your income statement. Now we've arrived. This was a crucial point to arrive at the beginning of the period and end of the period, the cash computation. So now we go back to the income statement and fill up that gap. Revenue calculation. Sorry, not revenue. Other income calculation. What is that other income calculation? Just put your cursor here and what it says. Interest income on the surplus cash. So find out as a percentage of your opening cash balance. Now we have got the opening cash balance, right? So it is a percentage. So what is a percentage of the other income? Percentage of the other income is how much? It is 5%. Yes, percentage of other income is 5%. Please come to the general assumptions here at the top. After your debt computation, we have interest income of how much? It is 5%. So additional income earned by investing the funds, by investing the amount is 5%. So see here, find out as a percentage of the opening cash balance. So now complete this gap. Okay. So let's start with this computation. So please come to the income statement above. Now for year one, it will be nil because year zero is the initial period. You can't come for year one, the other income computation. You have to start with year two equals to. Okay, so for year one, see it is nil. Okay, so for year two, what we have got? This. So let's see what comes up for us. Yes. So see your complete amount changes. And for the rest also you're going to calculate. See how your entire balance changes now. Once you add up these values, it will completely change. So how you have to compute? Start from year 2. So year 2, please go to the cash balance at the beginning of the period into 5%. That's all. So you've just elaborated the calculation here. So compute the other income for all the years from year 2 to year 4. So again, cross-check the values, how they've got auto-updated. Your gross profit, total cost of revenues, your gross profit coming up to your PAT, and then the rest. So once you calculate your other income, your final amount of PAT should look like this. Please cross-check. Your final amount of profit after tax, you have to get these values, which I've displayed it on the screen. And again, you have to come after completing that other income computation. Please come to the balance sheet. Again, there also we have to fill up the gap. Are you able to compute the other income and get the same values which is appearing on the screen for PAT? Yes.
Yes, ma'am.
Okay. Right. So please come to the balance sheet. Now here you have to update your what? Your closing cash balance in your balance sheet, which always you prepare, right? So for year one equals to, yeah, just take the cell reference, that's all. And for the rest of the year, you can just hold the values. So please make sure you get make sure you get the same value of total assets.
How do you compute the cash in assets?
Ju-
Principal?
uh, just take the cell referencing from year one. Now for year zero, it will be nil itself. We don't have the closing cash balance for year one as we start. So for year one, take the end of the period cash computation which we had done in the cash flow statement. So it has to be a cell referencing equals to this cell value. That's all. So we have arrived at the net cash balance in the end of the period from the cash flow statement. The same thing, we're going to refer it in the balance sheet. That's all. So I've just elaborated it for you here. Okay, E74. Hope it's clear. Please check your total assets value. See, one more thing you observed. That time we had some missing values and all that, and at the bottom we had this checksum. We had some values which need to be cross-checked. So now it is appearing nil over here because now all has been settled well. Okay. So I hope you have got the same value, total assets and total liabilities. So we have completed the cash flow statement successfully till cash flow statement. And now we arrive at the last two segments, which is your free cash flow equity. Okay, and finally your IRR calculation. So now, yes. Okay, so you have to post your net income here, your PAT is here, equals to for year 0, whatever it is there. So for year 1, yes, and for the rest of the years. And then to this, we add the depreciation element, the same thing, okay? So equals to, take the same, take the cell referencing here, depreciation. Again, capital expenditure. Remember, for the first year we had put up the capital expenditure. Debt repayment or raised. So again, equals to, say, so here we only consider the cell referencing. So debt repaid or raised. So yeah, issued or raised, yeah. And finally, the net cash flow for equity. So the net income arrived, okay. So here we consider the additions and the subtraction from the net income, nothing but your profit after tax, to finally arrive at the cash flow for raising funds through equity. So please complete this free cash flow to equity table, and then we go for this return analysis.
Ma'am, can you just show me a balance sheet assets total? For me, it's not the same.
Balance sheet total assets. Yeah.
Yes, ma'am.
See, I've displayed it.
Ma'am, the total assets, I'm not able to get the same values. That entire row.
Just check your cash values first, whether you're able to get the same values for cash at the end of the period. First, check your cash balance from year 0 to year 4. Then your property, plant, and equipment, the gross value, that'll be the same. That'll not change for all the years. So check each and every row. Where there is any difference, then let me know where you've got the difference in values.
I checked, ma'am. The difference is only in the total assets row, from year 0 to year 4.
No, when all the values are the same, there it cannot be difference, right? Now you have got, see, total assets is nothing but the sum only. See, sum in the sense it is your cash balance plus your net balance of your property, plant, and equipment. Because this we can't take. No, it's a gross value minus depreciation. It is a net value. So you have to take cash plus the net value of your property, plant, and equipment. That is your total assets. Maybe I think you have taken the whole sum, I believe. That's why you're getting difference in values. Just check this, because total assets is cash balance at the end of the period plus your value of property, plant, and equipment at the end of the period. That's all. I have not considered the entire selection here, the range here from D44 to D47. Maybe here I think you have gone wrong. Just cross check once. Now I think you've got the same value for total assets. Where
Yes,
we
ma'am. Now I got it.
Yeah. Fine. So now come to the final part, which is your return analysis. Hope all of you have got this cash flow to equity. Till here, it's all fine. I hope there's no difference in values. In case if it is there, let me know. Maybe the correction can be made. If not, we proceed to the last segment. I hope everything is fine. So here we come to the return analysis, the last portion where you're going to compute where you're going to compute the IRR. So for that, again, take the cell referencing of your last segment, which is cash flow to equity over here. Free cash flow equity equals to this amount. That's all. And then take it for all the years. And finally calculate your IRR equals to internal rate of return. Yes, from year 0 to year 4. So your IRR should be 29.63%. So I'll just elaborate the IRR here. You can just work out the IRR. I hope you have got the IRR answer as 29.63%. Yes. So which means here it is IRR calculation is 29.63%. So it is a reasonable percentage. It is a reasonable rate where in this project, okay, investment can be made. Okay, so hence this project can can go ahead in a long way, as we have got 29.63 as the IRR. Hope you've got the answer. If you've not got, you can unmute yourself and you can clarify your doubt. Yep. Fine. So now we have come to the end of the Volvo case study. Okay. So it says evaluate the business proposal of running a premium bus service between Mumbai and Pune. So we have made the evaluation of this proposal and we have found out that the IRR comes up to 29.63%, nearly 30%. So as per the analysis made, the investment for this project can be successfully done, confidently done, because it has got a lot of, I can say, uh, maybe future profits are very high. So henceforth, this can be done, investments can be made, and the risk element is considerably less. So I hope all of you have finished with this case study. Okay, so just give me nothing to work in the last 10 minutes, but I'm going to share with you the Toyota case study, which is the other fourth case study which you'll be handling for tomorrow. So today, for 5-10 minutes, you can just go through that case study. It'll help us to solve for tomorrow's class. So I'll just forward you the Word file as well as the Excel workbook. Give me 2 minutes time. Okay. See, I'm just forwarding the Toyota case study Word file. Please download that file and just go through that, please. Maybe Excel workbook, I'll do one thing. I'll just give it to you tomorrow. Now we just go through that case study of Toyotas, please. Last 5-7 minutes, please go through that case study. Workbook I will discuss later in the tomorrow's class. So now go through, I'll just have a brief discussion on that. Please download that file and go through the case study.
Ma'am, I'm so sorry, but can you show the IRR again, ma'am?
Yeah, sure, I'll
I'll
show you
do
that.
this, ma'am.
Sure. See, I've displayed the IRR calculation.
Ma'am, my values are exact as it is, but I'm still not getting the answer.
Equals to IRR. Well, that's all. Consider from year 0 to year 4 the values.
Yes, ma'am, I did that.
Huh. Well, there is no other additional calculation here. Have you got the same free cash flow equity? Just check the values again. Is there any change over there or any method of computation? Because what happens in Excel, right? One small change can target your answer only. So to be very careful. Now see, the time I told that total assets you were not able to get. So see, all the values appear the same. But the moment you did your sum, instead of considering only cash and net assets, so everything went wrong. So each and every element you just cross check once. Where you have to start with is, now see, check your liabilities computation. This is nothing actually. See here we take debt and equity computation and retained profit. So how I've referred the cell, you just check once here with the liabilities first. If everything is matching, then check your cash flows once. So each and every row you just check and then make sure I think you'll be able to get the error once all these corrections are done. Cross check once. What about the rest of the crowd? Have you got the answer? Have you got the IRR calculated?
Yes, ma'am.
Only Akhil and the other one is active. The rest. Isha, Nikita, Tulisin, Kirtana, Kashish, Mark Anthony, Deepshika. Riddhi. So please go to the Toyota case study. I request you all just go through that Word file which I've sent you because it'll be easier. I've displayed you the cash flow statement, man. Just cross check it where you're not getting your IRR. I'll leave it to you. So the Toyota case study, what I've given it to you, I hope you were able to download that file. Did you have any issues downloading that file? I hope all of you have received that file in the WhatsApp group.
Yes, ma'am.
So please download that file, go through that case study because tomorrow we'll be doing the same case study in your tomorrow's class. Toyota's one. Okay, so any doubts till here? I hope all of you have got the answer. In case if you have, you can just ask. Or I'll wind
No
up the
worries,
session.
ma'am.
Fine. So I'll wind up the session for the day. Thank you all. We'll meet up in the next class.
Thank you, ma'am.